Hi, I'm Rebekah Marlow, and for Case 1, I chose to cover Chapter 3 for East Coast Yachts. So, some background information. So, after Dan analyzed East Coast Yachts' cash flow, Larissa is now curious about the company's performance and their future growth plans. So, she wants to see how the company's performing relative to their peers, and she wants to find out the future financing that is going to be necessary to fund the company's growth. And in the past, the company has experienced financing difficulties, and they've actually had to turn down some jobs because they didn't have the capacity and the space to perform them. So the questions I'm going to be answering today are: should preferred stock be included as part of the company's total equity? I need to calculate the ratios for East Coast Yachts, compare these ratios to the performance of their competitors in the industry, and then comment on whether each ratio might be viewed as positive or negative. Interpret this new ratio of inventory divided by current liabilities and compare it to the industry average. Calculate the sustainable growth rate, calculate external funds needed, prepare the pro forma income statement based on this growth rate, and then recalculate the ratios and note my observations from 2020 to 2021. So our first question is to determine whether or not preferred stock should be included in total equity, and the answer is yes, it should be included as part of the company's total equity because preferred stock is considered a form of equity on the balance sheet, and it's going to be treated as such in financial analysis. So even though it has some characteristics of debt, it is still considered part of equity because it is not a legal obligation to the company like debt would be. So now we are going to get into calculating our ratios. So current ratio is current assets divided by current liabilities, and East Coast Yachts had a ratio of 1.00. Quick ratio is going to be current assets minus inventory divided by your current liabilities, and this is going to be 0.61. Total asset turnover is sales divided by total assets, and they had a turnover of 1.52. Inventory turnover is going to be your cost of goods sold divided by your inventory, and they had 21.90. Receivables turnover is going to be those sales divided by your accounts receivable, and East Coast Yachts had 32.74 turnover. And for debt ratio, it's going to be your total assets minus your total equity divided by your total assets, and they had a ratio of 0.55. Debt equity ratio is going to be calculated by total debt divided by total equity, and so they had 1.21. The equity multiplier is going to be 1 plus this debt equity ratio, so 2.21. Interest coverage is going to be your EBIT divided by that interest, and it's going to be 7.02. Profit margin is net income divided by sales, and they have an 8.12% profit margin. Return on assets is net income divided by total assets, and they had 12.33%. And finally, return on equity is going to be your net income divided by your total equity, and they had 27.22%. So now we're going to get into comparing East Coast Yachts to its peers in the industry. So when it comes to liquidity ratios, both of East Coast Yachts' liquidity ratios were below the median for the industry, which shows that they're not as liquid as their peers may be. For turnover ratio, all three of their turnovers were above the upper quartile, which indicates that they have greater efficiency than their peers for turnover. Leverage ratios were similar to the median, which shows that they are pretty much on par, with the industry. Coverage was lower than the median, so this suggests that East Coast Yachts does not have its interest obligations or other obligations covered as well as their competitors do. Profit margin and the return on assets were both above the industry mean, which shows that East Coast Yachts, they're generating more net income for every dollar in sales and using their assets to generate more profit compared to peers. And then ROE was above the upper quartile, so it shows that East Coast Yachts is generating more in profit for every dollar in equity than the competitors, and they are having a higher return. So overall, they have above average profitability than their peers. So now moving into whether these ratios are going to be viewed as positive or negative relative to their industry. So first, for the liquidity ratios, this is going to be viewed negatively compared to the industry. They have a current ratio of 1.00, which means they have exactly enough current assets to cover their current liabilities. So this suggests that they have struggle and difficulty to meet their short-term obligations, and this can also be seen with their quick ratio of 0.56. So it shows that they only have 0.56 of readily available assets, which again suggests struggle to meet short-term obligations. For turnover ratios, they have ratios that are much higher than the industry upper quartile, so this shows that very positive. They have a high turnover that indicates efficiency at using their assets and asset management. They have efficiency in their inventory management and quickly selling inventory to minimize storage costs and risk of obsolescence. And they have efficient collection of receivables, which means they're quickly converting their sales into cash and improving their cash flow and reducing their risk of bad debts. For leverage, they're slightly above the median, so it suggests that they have a balanced approach to financing, where the company is using debt but not excessively. They're using their leverage to enhance and amplify returns, but not to an excessive degree. East Coast yachts' coverage ratios compared to the industry are going to be seen as negative because they have a ratio below the median, which is going to suggest they have difficulty covering their expenses, such as covering the interest obligations, relative to the industry. For profitability, these are all going to be very positive. They have a high profit margin, which is above the median, so it indicates that they're effectively controlling their costs and generating profits from sales. They're suggesting efficient operations and pricing strategies. Having an ROA that's above the median shows that they're effectively using their assets to generate profits. They're reflecting strong asset management and profitability. And then an ROE that is above the upper quartile, it suggests, they're generating high returns for their shareholders. They're having efficient use of equity financing, and they have very strong profitability. So now we are going to look into calculating this new ratio, this inventory divided by current liabilities. So East Coast Yachts inventory divided by current liabilities is 0.4. And this ratio, basically, it shows how much current liabilities are covered by inventory alone. So this low ratio suggests that there's a healthy balance between inventory, current liabilities, and it suggests that the company is relying more on other current assets to meet their short-term obligations. So in order to compare this to the industry average, we kind of have to make an inference using our current ratio and inventory turnover. So compared to the median, East Coast Yachts has a lower current ratio and a significantly higher inventory turnover. And so a lower current ratio suggests that there's a lower proportion of current assets relative to current liabilities, while a higher inventory rate turnover suggests it turns over inventory more quickly than its industry peers. So together, these ratios suggest that East Coast Yachts likely has a lower inventory to current liabilities ratio than the industry average. So now we are calculating our sustainable growth rate. So we have the formula, which is ROE times B divided by 1 minus ROE times B. So B is going to be calculated by taking 1 minus your dividend payout ratio. And to calculate this dividend payout ratio, you simply take dividends divided by your net income. So after calculating all these numbers, having our ROE, sustainable growth rate can be calculated as 18.24% for East Coast Yachts. Alrighty, so now that we have our sustainable growth rate, we're going to switch into our external funds needed. So there's a formula approach, which, as you can see the formula here on the screen, and once we take in all our numbers, we have our assets divided by sales, we calculated our change in sales using our growth rate, we have our accounts payable as our spontaneous liabilities, times it by the change, we have our profit margin, all of that, you get 28,842,130. When you are calculating external funds needed from your pro forma statements, which we'll see on the next slides, you get an external financing needed of 27,030,770. So because the formula has assumptions, this is why that these two numbers are different. So now it's time to prepare our pro forma income statement. So as we can see, our sales, our cost of goods sold, selling, general and administrative, depreciation, those are all going to grow by our 18.24%, and then we're able to calculate our EBIT. Our interest expense is not going to multiplied by this growth rate because it's not directly tied to business operations that are being projected for growth in this analysis. So it's considered a financing expense, so we don't multiply it. So once we are able to find our new EBT, then we multiply that by the 25% tax rate to get our taxes, and we subtract those taxes out to get the net income. Now to calculate our dividends, you take the dividend payout ratio, which is 0.4334, and you times it by your net income. And then to calculate our retained earnings, we take net income minus our calculated dividends. So now we are preparing our pro forma balance sheet. So our current asset side, everything on that side is going to be multiplied by our 18.24% growth rate. Our current liabilities, both of those numbers are also going to be multiplied by that growth rate. However, our long-term debt and all of our stockholder equity numbers, apart from our accumulated retained earnings, are not going to be multiplied by the growth rate because they will not automatically change with sales. So to calculate our accumulated retained earnings, that's not going to be multiplied by the growth rate either, because it was explicitly calculated based on projected net income and dividends from the income statement, because it does not vary from sales. And so after we have everything calculated and we have all our numbers figured out, we are able to calculate our external financing needed by subtracting total assets and total liabilities and shareholders' equity. So now that we've prepared our pro forma financial statements, we're able to recalculate the ratios and see what we observe. So all of our liquidity and turnover ratios on this slide stay the same because all of their components that make up the ratio grew by the growth rate. So if they grew by the same growth rate, they're going to have the same ratios. So our debt ratio remained stable and the same, which suggests that there's a consistent level of financial leverage. So our debt to equity ratio decreased, and this suggests there's a decrease in the company's reliance on debt relative to equity. And the equity multiplier also decreased, which indicates a decrease in the company's financial leverage, which kind of contradicts the total debt ratio staying the same. The interest coverage increase, which this is a positive, it indicates that there's an improved ability to cover interest obligations. Our profit margin increase, which indicates an improvement in profitability relative to their sales. We had an increase on our return on assets, which suggests the company is generating slightly more profit per dollar of assets. And finally, our ROE increase, which indicates a higher return for shareholders. So overall, improvements we can see in profitability and coverage. There's decrease in leverage, and then we have stable ratios for our liquidity and turnover.